So you are welcome again to Equity Professionals. Tonight, we are going to be looking at a new topic, and this topic is financial instruments. Financial instruments. Remember that last week we started and we also finished up with IS 38 on intangible assets. And I can remember I gave you a test last week. We didn't have class last week. It was a test we did. So I think we are, and a lot of you submitted, while some of you did not. I've posted the results on the group. And let's just move on. We'll be progressing as we move through the courses. So what are we looking at today? What are we looking at tonight on financial instruments? So the first thing I need to tell you is that when talking about financial instruments, what this topic would basically speak about is all around debt and equity instruments. So financial instruments is all about debt and equity instruments. So when we say debt instrument, what do we mean by that? Debt instrument is just a way, or let me say an instrument that is used to raise money by an entity. And this instrument, it could be either loan stock, it could be debenture, could be bonds, it could be commercial paper. So basically, companies use it to borrow money. And usually, the borrower will call that person an issuer, because they will usually issue an instrument, usually a document. They will issue it out that please borrow me money. Then people will give them money. So you see those people that are lending money through these debt instruments, we call them investor. So basically, debt instrument is just used to raise money and specifically to borrow money. So the borrower, we call the person the issuer. The lender is called an investor. For equity instruments, this one also is an instrument that is used to borrow money. And usually it could be share capital, either ordinary share capital or preference share capital. So when an entity uses equity instruments to raise money, the investor, those that are giving the company money, automatically becomes a part owner of that company or a shareholder, becomes a part owner of the company. So if I come and meet any of you, if I issue my equity instruments to you, it means that I'm issuing shares to you. And if you buy it, you become a part owner. Just like when banks were issuing their shares out of late last year. What they are saying is that come and become a part owner in our company. They want to raise money, but when you buy those shares, you become a part owner in that company. That is what equity instrument does. So basically, you will see that whether debt instruments or equity instruments, there will be at least two parties. There have to be at least two parties. If you want to borrow money, you use debt. You that you are borrowing, you're a party. The person that will give you money is another party. If you want to use equity instruments, there will also be two parties as well. So before you can have this debt or equity instruments to be valid, at least two parties must agree and come together. So tonight, within the few minutes I will use to teach you tonight, I would basically be introducing to you how to account for debt instruments and equity instruments. That's basically what I want to teach you on this topic. Of course, any topic in reporting, mostly that have to do with transactions, there's always a standard that guides us in the treatment of those transactions. So for financial instruments, I'll be using two standards to teach you financial instruments. I'll be using two standards. I'll use IS 32. IS 32 talks about financial instrument presentations, and I'll also use IFRS 9. IFRS 9 talks about financial instruments, recognition and measurement, and all that. Tonight, I will teach you some parts of IS 32. I can't teach you everything. And also, I will introduce a little part in IFRS 9 tonight. So these are the two standards we're going to use. Of course, I won't touch IFRS 7. So I'll be using IS 32 and also IFRS 9 to teach you this topic. For IS 32, I will use IS 32 to define some terms that we need to get familiar with. And of course, the objective and scope of IS 32, but definition will come handy. Also, IS 32 will talk about how you classify these financial instruments between it being a liability or equity. You understand that very soon. And also, I will teach you about presentation of compound financial instruments. IS 32 will take care of this. So then IFRS 9 will take care of the recognition and measurement. I'll take you some of that also today. So let's jump straight into IS 32. So basically, aside definitions that I would go into very soon, the core objective of IS 32, which you will see very soon, which is what I will spend almost 20 to 25 minutes on, the core objective of IS 32 is to teach you the principle of how do you present instruments as either liabilities or equity. That will be clear very soon. And of course, the principles of offsetting, which I'm not going to talk about for your class. I won't really be talking about that. And fundamentally, you need to understand that IS 32 does not cover equity interests that result in subsidiary, associate, and joint venture. I'm sure Mr. Abi has been teaching you group account, and you will see that the reason why we are preparing or why we prepare consolidated account is because one entity acquired equity interest in another to a level that it has significant influence and control, as the case may be. So that is also issue of equity. The subsidiary will have issued equity, then the parent acquired it. So the equity instrument I'm talking about here is the one that is less than 20%. Is one that is less than 20%. That if you buy shares in another company, it doesn't give you significant influence, it doesn't give you control. As you have known already, the one that gives you control, we call that subsidiary investments, and that is accounted for in line with IFRS 10. The equity investment, or when you buy shares in another company and gives you significant influence, that one, we call that associate investments, and IS 28 takes care of that. And there's another one called joint venture investments, where you have equal holding. IFRS 11 takes care of that. So Oh, yeah, that's not what we are talking about today at all. It's not, it's outside the scope of um it's outside the scope of IFRS IS 32. So substantially today, the one we are looking at is the one where your holding is less than 20%. Okay, we'll still narrow down on that. Now let's go to key definitions. Let's go to key definitions. Okay, so Latif, I saw you writing something above 50%. What are you talking about?
As in the group account that gives you control.
Okay. All right, no problem. No problem, but you really need to understand that if I'm sure they will have mentioned it to you that yes, the reason why we do group account is not just having holding above 50%. The main determinant is having control. That's the main determinant. You see, you can have control even with less than 50%. That's why somebody like Otedola can have 11% or 15% in First Bank and being able to be board chairman. He has control. So yes, a primary determinant is your holding, right? Theoretically, your holding. But IFRS 10 emphasized that what determines subsidiary investment is not just holding, it's not just voting right, but what gives you control. The same thing as significant influence. If they ask you in the exam, what are the indicators of significant influence? You will see that it's not just about having holding above 20%. Yes, voting right is there, but that's not the core determinant. I mean, if you can participate in board meetings, if you can make decision and all of that on the board, it's significant influence. So yes, you're not wrong, but you're not totally right at the same time. You need to understand it up to that extent. Okay, so that's just by the way. Now let's look at definitions of terms. So the first thing we need to narrow down on is financial instrument. Financial instrument. So IS 32 says that financial instrument is any contract that gives rise to financial asset of one entity and financial liability or equity instrument of another entity. It says financial instrument is any contract that gives rise to financial asset of one entity and financial liability or equity instrument of another entity. You have to know this definition. They can ask you in your exam. If you look at this definition, it says financial instrument is any contract, which means that before you can call an arrangement that, okay, this is a financial instrument arrangement, there has to be a contract first. And when we say contract, what makes a contract is something we call economic and legal consequences. It is not compulsory that it should be in writing. No. What is important is that there is an agreement between the parties and everybody knows what they are supposed to do. And they know that if they don't do it, there will be legal consequences. There will be economic consequences. That is a contract. An agreement between two parties that has clear economic and legal consequences. When there is a contract, for this contract to be a financial instrument contract, it must give rise to financial asset of one entity and financial liability or equity instrument of another entity. Which means that when we have this contract, one entity or one party must have a financial asset. And another party would have either a financial liability or equity. And you see, to identify the party that has a financial asset is relatively straightforward because it is always the investor that would have a financial asset. It's always the investor that will have a financial asset. While the other party would have either a financial liability or equity. So you need to be able to know what the other party has. Is it financial liability or equity? And you see, this other party would have a financial liability if the way he's raising the money, if he's using a debt instrument, remember, a debt instrument is you want to borrow money. It's an instrument used to borrow money. If the way you want to borrow the way you want to raise money is borrowing using debt instrument, that means you have a liability. But if the way you want to raise money is by issuing shares using equity instrument, then you have equity. And that is why I told you right from the beginning that everything I'm teaching you in this course is all about equity and debt, how to account for them. And this definition in IAS 32 already reflects that. He said it's a contract that gives rise to financial assets of one entity and a financial liability or equity instrument of another entity. Let's look at each of these elements because from this definition, there are three elements. There is financial assets, there is financial liability, and there is equity. Three elements. And I've told you, investor will always have financial assets, while the other party can have either of these two. So it depends. If the way he's raising money is through debt, then you should know that what he will have is financial liability. But if the way he's raising money is through equity, that means what you will have is an equity instrument. So that's how you identify the other side. So let's go deeper. Even though I've told you that he's an investor that will always have financial asset, but we really need to know what financial assets are. Now, there was a diet ICAN asked you to define financial asset and financial liability, 2 marks each. So you really need to know these definitions. So IS 32 says that financial asset is any asset that is cash, an equity instrument of another entity, and a contractual right to receive cash or another financial asset from another entity, or to exchange financial asset or financial liabilities with another entity under conditions that are potentially favorable to the entity. Okay, let's break this down. It says financial asset is any asset that is cash. So that means if you have cash, you have a financial asset. Financial asset is cash. And what is cash? Cash is cash. It doesn't have any other word to use for cash aside cash. So when you're talking about cash, then you should be thinking about either the money you have in your hand is your cash, or the money you have in your bank is your cash. Even your fixed deposits, your highly short-term investments can be cash. They can be cash. When you have cash, it is a financial asset. Secondly, financial asset is also an equity instrument of another entity. Equity instrument of another entity. What does this mean? It means that when you buy shares of another entity, because that's what we mean by equity instruments, shares, ordinary shares of another entity. That's financial asset. I mean, if let's say equity, our school, we need to raise money, we want to expand. So we issued out shares and you buy it. That's financial asset to you. Or maybe the recent bank recapitalization that made most banks to go out to the market to raise money. Let's say you buy some of their shares. It's financial asset to you. Yes, you're an investor. You have invested. That's financial asset. Because now you have equity instrument of another entity. If you buy shares in GT Bank, it means you have equity instrument of GT Bank. If you have shares in Shell, it means you have equity instrument of Shell. That is a financial asset to you. You're an investor. So that's very simple and clear. Thirdly, financial asset can also be a contractual right to receive cash. I will stop there first. Contractual right to receive cash. You see, when you have contractual right to receive cash, it simply means that the counterparty must pay you that cash at a due date. You must receive it. If they don't give it to you, you can sue. There would be economic and legal consequence because we are saying contractual right to receive cash. It means you must receive it without doing anything. That's contractual right to receive cash. And examples of contractual right to receive cash could be trade receivables, for example, now. If you have trade receivables, that's a contractual right to receive cash because that customer must pay. If he doesn't pay, you can sue that customer. Or if you have loan receivable, that is a contractual right to receive cash. If you have lease receivable or rent receivable, that is a financial asset because you have a contractual right to receive cash. If I may ask you, just to be sure that you are following me, if you have inventory, is that a financial asset? Does it give you contractual right to receive cash?
No,
No.
Why?
because it is neither cash nor equity instrument or right to receive cash.
That's correct.
Yeah.
That's correct. I agree with you. Inventory is not a financial asset. It doesn't give you contractual right to receive cash. But even though your explanation is not sweet enough, I mean, some others can argue that no, it gives you right to receive cash. No, it doesn't, because you need to make a lot of effort to sell it. You have to do marketing, you have to do a lot just to ensure you sell it. And you might not even end up selling. That's not contractual right to receive cash. Contractual right to receive cash means the money it's money you're expecting. You are not doing marketing, you're not doing anything. Is the money will just come. That's contractual right to receive cash. Just to be sure you're with me. So if you have an equipment that you're using to make shoes, for example, maybe a cobbler your shoes. So you have an equipment that you use to sell your shoes. That equipment, can it be a financial asset?
No.
Why?
Yes, yes.
Please. For me, I think it's no, because this equipment, it's not an item of sales. It's a means of production. And that equipment falls under PPE, plants. Yeah.
Okay, you say it's not an item of sale. What if it is an item of sale?
If it's an item of sale, it's still under, if it is an item of sale, it falls under, what's it called, inventory. So you still have to do a lot of marketing and all that to receive cash.
Okay. Okay, I hear you. Latif, you're saying something.
Yeah. If it is for rentals to others, once anybody applies for its use, that person must pay cash. So it gives you the right to receive cash.
Okay, good reasoning also. But the answer is no. It is not a financial asset. It doesn't give you contractual right to receive cash because that equipment, you are using it for production. And like Oliver said earlier, if you don't use it, you won't make money. And it is PPE. So, I mean, contractual right to receive cash means you don't have to do anything. All you're expecting is cash. You don't have to produce, you don't have to, just cash. Cash just have to come. That is right to receive cash. And you have equipment, I mean, you have to get labor, you have to do a lot of work to produce, then sell before you then make money. No. Something we call financial assets accurately means that it gives you money, just money. You won't do anything. They will just be sending you money. That's contractual right to receive cash. Okay, one more, just to be sure that you seriously get what we are talking about. Okay, Latif, go ahead.
So I'm sorry to engage you, sir. Since you said in the definition of PPE that it is what we held for usage in the production process or for administrative purpose or for rentals to others. So if you now have an item of PPE that if once you give it out for rentals, for as long as it is, they must pay you if it is for 2 years or 3 years. So that is also a right to receive cash. I think maybe you need to clarify that somewhere. Once you give it out for rentals, then you have the right to receive cash. So that's why I need you to please.
Okay, good reasoning again. So IFRS 16 would usually set in along the line. So when you lease out an item, then you would have a lease receivable or a net investment in the lease, right? So that lease receivable or net investment in the lease, that one is a financial asset. That money you're expecting, there's a way we account for it when I teach you IFRS 16. Okay, but that asset in itself, okay, at that point in time, that's not the financial asset. So it now depends on what and all of that. When it gets to rentals to others, then we need to then look at, okay, there's now a lease element. Then is that money you're expecting? We call it lease receivable or net investment in the lease. So your reasoning is right. I have to say that. But not the PPE itself. That is a financial asset. It's not. It's PPE. That one is an equipment, PPE. Okay, good questions. Let me give you one more just to be sure that you completely get it. So if you buy I want to assume everybody knows what a Bitcoin is. Bitcoin. I mean, I would have said cryptocurrency, but that might sound strange to you. So let me just say Bitcoin. But for your information, Bitcoin is just a cryptocurrency. There are other ones like that. There are a lot of them. But I think the most popular is Bitcoin. So let's say you bought a Bitcoin.
Hello, sir.
Yes.
I think it's not a financial asset.
Okay. Okay. No problem. Any other ideas? So you are very correct. You are correct. Since nobody is talking, I thought people will have spoken, but let's just go to the point. So you are actually correct. Bitcoin is not a financial asset, and that's because it is not cash, it is not shares, it doesn't give you a right to receive cash because you really need to work to sell it. You have to look for buyer and all of that if you really want to liquidate your Bitcoin. So it's not like it's not like it's something that you have to collect cash. No. When you want to, it's like an investment too. When you want to sell it, look for buyer, then you sell. And one would think that it is cash, that is a medium of exchange. No, it's not. And that's because IS7 says so. IS7 said that cash is a medium of exchange that is generally acceptable. So, of course, we can argue that Bitcoin is not generally acceptable. So, from that standpoint, we can say it's not cash. Even if it is generally acceptable, let's assume that, okay, everybody is accepting Bitcoin. It will not still be cash because IS7 says that cash is a medium of exchange that is generally acceptable and has an insignificant risk of changes in value. Meaning cash is not something that will be volatile. It's not something that would change in value very fast. I mean, Bitcoin can be $10,000 tonight. You wake up tomorrow and they say, it's $30,000. And that's a huge volatility. So Bitcoin doesn't qualify as cash. So it is not a financial asset. Okay, so you're absolutely correct, Latif. But if it is not a financial asset, then what type of asset is it? What class of assets can we put it in our books? Let's say you work with a company that bought Bitcoin. What class of asset are you going to put it?
That could be an inventory since it is for sale.
What if you are not holding it for sale?
Near the must have.
Yeah, that would be an intangible asset. So it meets, if you remember the definition I gave you for intangible asset, it actually meets it. So it is an identifiable because identifiable in the sense that you can sell it, you can transfer it, you can rent it out. Is identifiable. It is non-monetary. It's a non-monetary asset. Okay, and it is also without physical substance. And remember that non-monetary means that what you get from it varies. You're not sure how much you make from it. It varies. The value varies. So it is an intangible asset. And it can also be an inventory, as you have rightly said. It can be inventory as well. And it is inventory if the person that is holding it is holding it for sale. You know, there are all these exchange that usually hold this inventory for sale. That's where people buy them from. Those ones now in their books, it will be an inventory. But for people that are just buying it to hold, those ones in their books, it will be an intangible asset. Okay. So I think that's really thrown light on what financial asset is. But you see, this part of the definition, I took my time, I gave you scenarios on it because it's huge. You really need to, I will still give you more scenarios after the class today, which I will send to you, just to understand this contractual right to receive cash. So, because when you look at this definition, financial asset is cash. This part of this definition is very straightforward. Financial asset is equity instrument of another entity, also straightforward. But when it comes to right to receive cash, you need to understand that we are ultimately talking about your right to actually receive cash, nothing else, not something that you still have to work hard to generate cash for you. No, that one is not financial asset. This financial asset is right to receive cash means you are not doing anything. Money will flow. Okay. But the definition doesn't actually stop there, even though for now I would emphasize more on this part. But know that it's not just right to receive cash alone, it could be right to receive another financial asset from another entity. If you have right to receive shares, it's a financial asset to you. It can be a financial asset to you or any other financial assets if you have right to receive them. Also, if you exchange one set of financial assets with another, and the conditions for that exchange is favorable to you, in that exchange, that new financial assets or whatever it is, you can recognize it as a financial asset. Okay. So you can exchange one financial asset with another. You can exchange one receivables with another. You can exchange your shares that you bought with another shares of another company, something like that. So if the exchange is favorable to you, then you put it in your books as a financial asset. Okay. But for now, I mean, what I want you to really understand first, before you bother yourself about this other part of the definition, even though if I can ask you define financial assets, you must tell them everything. Okay. But I need you to really think through contractual right to receive cash. Just stop to this point first. Then we're going to advance as we move. Financial liability. Financial liability is any liability that is a contractual obligation to deliver cash. Contractual obligation to deliver cash. So, like if you have trade payables, that means you have an obligation to deliver cash because you have to pay the supplier, or you have loans payable. You have to pay your creditor, or you have lease payable or lease liability or rent payable. You have an obligation to deliver cash. So those are obligations to deliver cash. So liabilities, there's a liability we call contract liability. That contract liability is when you collect money from somebody and you're supposed to offer service to that person, but you haven't rendered the service. It's just like this class now. Some of you have fully paid your lecture fees. So IFRS 15 requires that money you paid for the full lecture fees, that we are not supposed to recognize everything as revenue because we have not fully rendered the service. So a portion of that money, we should put it as a liability for now until we render all the service before everything can go to income. So you see that liability for the money we collected for which we have not rendered the service, that kind of liability cannot be a financial liability simply because we don't have obligation to deliver cash to you anymore. Yes, we have collected money from you, but the obligation we have is to deliver service to you. Is to deliver service to you, not to deliver cash. So also, if you have taxes, let's say company income tax, like your current tax, for example. You see, current tax is not a financial liability. Even though you have an obligation to deliver cash, yes, but that obligation is not contractual. You don't have a contract with the government. That obligation is a legal obligation. You have obligation to pay tax. So current tax is not a financial liability because it is a legal obligation to deliver cash, not a contractual obligation to deliver cash. So you will see that all elements in this are very and extremely important. I mean, in a like manner, speaking of this contractual right to receive cash also, if you have something like prepayments, like prepaid rent, for example, now, you paid rent in advance to a landlord. So let's say you pay 2-year rent. Accounting will say, okay, there's a portion of the rent that is prepaid. So we put that as asset. That prepaid rent that we put as asset in our books, it doesn't qualify as a financial asset because the right we have is not to receive cash. The right we have is to receive a service and not cash. Is to receive a service and not cash. Finally, is equity instruments. And equity instruments are majorly share capital and reserves. Share capital and reserves. And I hope you still remember the definition of equity instruments I taught you in the conceptual framework. I hope you still remember. Remember that equity instruments is a residual interest in the asset of an entity after deducting all its liabilities. Residual interest. That's why you have share capital. Share capital is a residual interest. They are the one you settle last. So also your retained earnings is equity because that is what is left after you have settled everybody, retained earnings. All your reserves, they are equity. They are what is remaining after you have removed the what and what not from them. Okay. So you see, IS 32 gave us all these definitions. IS 32 knows that it's quite easy to identify in that arrangement who has a financial asset when you have either a debt instrument arrangement or you have an equity instrument arrangement. You can easily know that, okay, is the guy that is investing that has a financial asset. But you see the other party, you need to think a little bit to know what the other party has. Does he have an equity or liability? Looking at that definition I gave you for financial instruments. So one of the core of IS 32 is your ability to know what the issuer has. And I've told you already that if what the issuer is using to raise money is through debt instruments, where, and you know what debt is, I mean, I've borrowed money, I have to pay back. Then he has a financial liability. Then if he's using share capital to raise money, then we have equity instrument. So, I mean, to round up IS 32, especially on the part of understanding whether a financial instrument, whether the issuer has an equity instrument or a debt instrument, I will give you 3 scenarios. And these scenarios, I really want you to participate and answer. So I really want you to open your eyes and understand these once and for all. Try to participate, every one of you. So 3 scenarios we'll look at. So the first scenario, a company issued an irredeemable preference shares. And dividend, let me say preference dividend will only be paid to these preference shares when we pay dividend to our ordinary shareholders. Let me repeat myself. A company issued irredeemable. I'm sure you know what irredeemable preference share is. Do any of you know what irredeemable preference shares is? Anybody?
Yeah, it is a preference share that has both more or less like have a future of a share, ordinary shareholding. It has a constant return and it cannot be redeemed.
Okay, you tried. Is the part of constant return that we are not sure. It might have, it might not. So, but irredeemable preference shares, the part where you said it cannot be redeemed, that one is right. In the sense that we are not going to pay them back their principal. We won't pay them back, so it is irredeemable. We won't pay them back their, that's, I mean, from the name. Okay, good. So this company issued that irredeemable preference shares, right? But dividend is only paid to these irredeemable preference shares only when we pay dividend to our ordinary shares, which means that if we don't pay dividend to ordinary shares, they will not get dividend. If we pay dividend to our ordinary shares, they will get dividend. That's what it means. So they now ask you that this irredeemable preference shares, should you classify it as an equity instrument or as a financial liability? What do you think? Should you classify it as an equity instrument or a financial liability? I mean, I just need the answer I need from you is just, I mean, just tell me, is it equity or debt? Just choose one. You're free to choose anyone.
Debt. Sir, hello, sir.
I want anybody that wants to talk and talk, but I really want every one of you to, if you're not going to say anything, you can just type your answer. But you really have to participate in this one because it's really a past question. So I really have to use this one to gauge my next action for you. So I want you to participate here.
Please.
Who's going first? You can go ahead, Oliver.
Yeah, it is a financial asset.
Sorry?
It is a financial asset.
You issue preference shares. Okay.
No, okay, me issued preference shares is a
Yes.
financial liability.
Okay.
It's a financial liability, sir.
All right. Noted. Financial ability from you. So I have your answer. I have another person saying that it's an equity instrument. Latif, you're raising up your hand. You can go ahead.
Okay, sir. If I am the one that raised the equity instrument, then I have the financial liability. I want to stand. I think that is what I will say, sir.
I didn't even understand your answer because you said if you are the one that raised the equity instrument, you have a
Uh,
financial liability. What's that?
no, the question you asked was that,
Oh,
is it on the part of the investor or the company that raised the equity instrument or what?
It's the company now, the company that issued. The investor is really none of our business for now. It's the company.
Then I have a financial liability.
Okay. Okay. I have a sizable answer. Out of 16 of you, I have like 2, 3, 4, 5, 6, 7 people. That means the other 6 or 10 are sleeping already. That's fine. You watch the video later. Okay. So those of you that said equity instruments are correct. And you'll have gotten 5 marks in the exam. This was for 5 marks. I think it was 2 diets ago or something like that. And why are you correct? 2 reasons. 2 reasons. Number 1, they told us that it's an irredeemable preference shares. It's an irredeemable preference. Irredeemable means we are not paying back. It's just like ordinary shares. That's equity. It means we are not going to pay you back your money. We have issued irredeemable preference shares. That means give us money, borrow, give us money, and that money we use it till whenever. That's equity. That's not the only reason. The another major reason, which is the key determinant, is the fact that we don't even pay them dividend until we pay dividend to our ordinary shares. That means they are the same thing, that means they are a residual interest. That's what it means. We only pay dividend to them when we pay dividend to our ordinary shares. That means they are like ordinary shares also. So they are equity. But if the question was that this irredeemable preference shares, so we pay them fixed interest, meaning we pay them interest every year. That means it becomes a liability. That is when it is a liability, because at that point, we would have an obligation to deliver that fixed. Or if they told us that this preference shares is redeemable, if they tell us that it is redeemable, that is also a liability, because that means redeemable means we have to pay back your capital as at a due date, as at a fixed date. Means we have an obligation to deliver cash. But in this case, they told you that it is an irredeemable preference shares, and we only pay dividend to them when we pay dividend to our ordinary shares. So it is an equity instrument because they have the characteristics of an equity instrument. They are a residual interest. 5 marks. Picking one. Okay. Let's go to the second scenario. Those of you that did not get this one right, I hope you will get the second one right. The second scenario. This one states that let's say Wasiu PLC. Let me use my name. Wasiu PLC acquired equipment from a supplier. Wasiu PLC acquired equipment from a supplier. And Wasiu PLC is going to pay for this equipment by giving its shares, its ordinary shares, to this supplier. And the value of the shares it will give is 5 million naira in 2 years' time. Meaning that, you know that if I buy equipment, ordinarily I should just pay cash, right? But this question is saying that I'm not paying cash. Now, what I'm giving to this guy, what I will give to this guy is my ordinary shares. I'm going to pay him with my shares. That take my shares. So for this equipment I'm buying from you, I'm paying with my shares. However, I'm not capping the value. That the value of these shares will not be more than is 5 million. And I'm not going to give you these shares until after 2 years. Until after 2 years. That is when I will give you these shares. The question is, these shares that I want to give this supplier, how am I going to put it in my books today? Because, I've collected equipment. It's like I bought an equipment. I will debit bank. I said bank. I will debit equipment. But since I'm not paying cash, I'm giving my shares. So what am I going to credit? Will it be financial liability or equity? So the shares that I'm giving to this supplier, will it be financial liability or equity? Listen to it again for the last time. I bought equipment from a supplier. I'm going to pay with my shares. I will issue shares to the guy for that equipment. But the shares, I'm going to give him in 2 years' time, and the value of the shares I'm giving is 5 million naira. How should we treat these shares in our books today? Should it be an equity, as in share capital, or should it be financial liability? What do you think? I really need everyone to participate, either by typing or by talking, or whatever way that is convenient for you. Reginald said financial liability. Prudence said financial liability. Aisha said financial liability. Ahmed said financial liability. Latif said equity instruments. Okay. Jacinta said financial liability because of the time frame. Lukman said equity. Okay. So nobody is okay. Is there anybody that wants to talk? Okay, another person said it's financial liability. Okay. Joy said financial liability. Joseph financial liability. No, Joseph said equity. Winner said financial liability. Okay, Oliver, let's hear from you.
Okay, sir. I think in this case, it's a financial liability. The reason, even though what was raised was actually an equity, but it is being used to offset a debt, and it to be in the future. So I think it's a financial liability on the part of the fellow who raised it.
Okay. Okay, but I mean, your explanation didn't, I don't know why you think, because what I've taught you about financial liability is that is an obligation to deliver cash. Am I delivering cash? I mean, I'm very curious because a lot of you are saying it's financial liability. Two people said it's equity, Latif and Lukman and Joseph. So, and somebody even said it's financial asset, that it looks like financial assets. I don't know. I don't know if you wish to tell us why do you think it looks like financial asset?
Okay, so when you were talking about financial asset, you said something about asset that gave rise to cash and this shared debenture, something like that.
Yeah.
Yeah. So when you mentioned about that you are going to give him a share in your company. So that's when the thing started looking like a financial asset to me.
Oh no, it's not a financial asset. Financial asset is the investor. Is the person that is putting money down, is the person that is investing. Me now, I'm issuing my shares. I'm not
Okay.
investing.
Okay.
Okay. So it's not financial asset at all. It's far from it. Okay.
Hello?
Yes, Reginald.
Yeah, so I said financial liability because the definition says it's a contractual obligation to deliver cash or another financial assets to another equity.
Okay.
Doesn't
So
that
you're
make
saying,
sense?
okay, I get what you're saying. So you are basing your answer on the fact that it's not cash alone, it could be another financial asset, Abi? And in this
Correct.
case, we want to deliver shares, which is a financial asset. So that's a financial liability. Okay. Good logic. At least you tried. Good logic. So those that said financial liability are correct, which majority of you mentioned. You guys are correct.
How?
Yeah, I'll tell you. I'll tell you. So the reason why it is a financial asset is not what Reginald said. That's not the actual reason. Because when you want to deliver shares, that's not financial liability at all. That is equity. That one is straight equity. So this to deliver another financial asset, right? It has more stories to it. It has plenty stories to it. Even though it looks as serious when you are delivering shares, that's financial liability. No, far from it. Because primarily, when you want to deliver shares, when you are issuing shares, that's your share capital now. We put that as share capital in our books. That's share capital, nothing more. However, in this case, the shares we are issuing is anchored on 5 million naira, meaning the value must be 5 million naira. Therefore, if the value of the shares will be 5 million naira or cannot be more than 5 million naira when we are giving it to the person, it means and we are going to issue the shares in like 2 years' time. So it means we don't know how many shares we issue. It means that the number of shares we are going to issue ultimately will depend on the share price in that 2 years' time. And it means that the shares we want to deliver is a variable number of shares. And IS 32 says that when you are delivering a variable number of shares, that is a financial liability. It's very clear in IS 32, even though I haven't mentioned it in this class, but now I'm mentioning it. So for delivery of shares, issue of shares, to be equity, we have to be issuing or delivering a fixed number of shares. We need to know how many shares we are issuing. You won't just say that it should be this value. It becomes variable. And if the number of shares is not fixed, because if you want to take something to share capital account, we need to, because it's affecting the number of shares too. Because anything that goes to share capital account is at nominal value. So we need to know how many shares. And that's the reason why this one is financial liability. Because we are issuing a variable number of shares. So that uncertainty in regards to the number of shares we issue, that's an obligation. That's an exposure for the company. And that's why S32 says that when you are to deliver a variable number of shares, where you don't know how many shares you deliver, that will be a financial liability. Just like in this case, we want to deliver shares to this supplier. They now told us that the value should be 5 million naira, the value of the shares. They didn't tell you the number of shares. They only told you the value. So that means the number of shares you will issue in 2 years' time will now depend on the share price then. So it's a financial liability. Most of you are perfectly correct. Just that you won't get the full 5 because they really want you to also explain why it is a financial liability. And the reason is because we are issuing a variable number of shares. And not only that, you need to go further to tell the examiner that since these shares will be issued in 2 years, and we are saying it's a financial liability because the number of shares we are issuing is variable. You see, that 5 million that we are putting in our books as a financial liability today, you will not put that 5 million there as 5 million because that 5 million is a future value. That 5 million is the value of the shares in 2 years. So you need to get the present value of that 5 million. It is that present value that you put in your books today, and you call it financial liability. And that is the solution to that. All this explanation I'm giving you, I think that question is here. Oh, okay. I will not transfer it to this part. I will send you that question and the solution so that you have it and be able to revise it. At least when you're watching this video, you can listen to my explanations. Okay. Let me give you the final scenario. Let me give you the final scenario. And I hope everybody gets this one right. So the final scenario states that a company usually gives shares to its directors. When I say give shares to its director, it's not for free, they will buy it new. But I mean, whatever price, but they shall give them shares. Whether they buy it or they not, it doesn't really affect the accounting here anyways. So they give shares to their directors. As soon as the director resign or stop being a director, the company will buy it back from them. I mean the shares. So these shares in question now, should it be a financial liability or share capital or equity? I mean, when I say share capital, I mean equity. So should it be equity or financial liability? We issue shares to our director. These shares we have issued to them when they resign or they retire or they stop being a director, we will buy it back from them. Meaning we'll collect the shares and give them money. So would this be a financial liability or equity? The shares itself. Everybody participates. I mean, this is the last part of the class. Should it be financial liability or equity? Okay. Reginald Bell the cards. He said is equity. Others, what do you think? Muibat, equity, Prudence, equity, equity. Aisha said that she said is a financial liability as it seems to be redeemable. Fantastic. So she's moving away from every one of you. She said she doesn't agree with you, that she thinks it should be financial liability. Any other observation? Okay, it seems nobody else is going to contribute. Okay, Jacinta also followed up. She said it's financial liability. Any other one before we close the voting room? Okay. Okay. So, which one is correct? Financial liability or equity? Financial liability is the answer. Financial liability is the answer. And the reason is, I mean, she was spot on. Aisha was very spot on. Because we'll buy it back from them. We'll buy it back. It's redeemable. That's what she said. Very, very smart of you. It's redeemable. We'll buy it back from them. That means it's a liability because we have obligation to deliver cash. Equity doesn't have obligation to deliver cash. It's only liability that has obligation to deliver cash. For tonight, I'm going to stop here. And immediately I'm sending you 9 scenarios. I don't want to move. I really need you to go and master this. These 3 scenarios, you tried, but ICAN can still ask scenarios like that. So before we come to class next week, this is like another test. For those of you that did not do the last test, this is like another one for you to redeem yourself. So those that did not do that first one, you must go and do it too. It's compulsory. So I'm sending you another one. And this one is basically will give you several scenarios. And all you need to do is to tell me whether the instrument is a financial liability or equity, just like I'm asking you here now. So please and please make sure you do it. If you are still in the mood, if you still have the energy, you can look at it tonight, send me the answer if you can. But the deadline for submission is Tuesday, before the end of Tuesday. That's the deadline for submission. So I have posted it to the group. You can have those 9 scenarios there. Please look at it, use it to master everything. So if a lot of you look at it, then in our next class, I might give you some other scenario to take care of. As aside to deliver cash, I can explain another financial asset with scenarios. I can explain exchange, but those ones are not really critical for your exams that much, but I might decide to go further on it if I want to. But make sure you get hold of that liability would exist if you have an obligation to deliver cash. And for equity doesn't have any obligation. Equity is residual. So you really need to know when an instrument is equity and when it is liability. You really need to, that's IS 32. That's the core objective of IS 32. So please attend to those questions. So the next week we'll start recognition, measurement, and the other ones like that. So we'll finish up those ones. That one is another complex one entirely. So we have deviated from our plan, from the plan we had at the beginning. We are supposed to be having classes on Thursday, but Mr. B is just disrupting my plan. He will say we'll come, he will not come, he will miss, will not miss, and all of that. And I'm trying to also make sure that we are carrying one another along. And this is already March. So we need to work harder this time around, because by the end of March, we need to have gone very far. Otherwise, pressure will set in April, because in April you will now be looking at exam is next month too, and we have plenty things to cover. That's when students will start becoming apprehensive. We have plenty things to cover. We have plenty things to cover, and they will have forgotten that we had some delays in March and in February. So we need to find a way to see if we can make up, but I would try and see that possibility. But besides that, I'll be giving you a lot of work to do in this month. I mean, be ready to work hard, not for me, but for yourself, so that you would pass these exams. So almost at the end of every class, I'll be dropping exam-related corrections, both for the one we have done for that day and the ones you have done prior. So as soon as you submit this one on Tuesday, I'm going to drop another one on Wednesday, and that one will be on IS 38, and you're supposed to submit that one also by Thursday. So I know we are busy, but we need to pass this exam as well. It's important that we don't fail. So, and if you're doing these things and I'm dropping, at least for FR that me and Abby is teaching you, I'm 100% sure that you will not fail. I can guarantee you that, provided you start doing all of these things, you would follow up with what we are doing right now in this class going forward. And so let's see how it goes. And I will let you know if we would be having any other class before next week, Sunday. I will let you know. And we might be having I might be coming in a little late. Like today now, I had to come in a little late. I mean, sincerely, it's because I had not finished eating, I mean, Muslim and we are fasting and all of that. So we'll break our fast like after 7, we'll pray, then we eat like that. That's why I had to come in a little late, and coupled with the fact that I traveled and all of that. So, I mean, we would work it out. It won't delay or affect our classes. Okay, so Latif, you want to say something?
Yes, sir.
Yes, go ahead, please.
Thank you so much for the effort to date. However, sir, I don't know if there is any way that you need to meet Mr. Abbey. Maybe anyhow you see how that whatever he can do, so that, because to my own thinking, sir, we have missed 2 classes as per Mr. Abbey's class. If peradventure we miss another class again, definitely there will be pressure, because I know you
Yes.
still has short time. So I will wish that there is something that you can come up with in that aspect, so that there won't be any kind of pressure on us later. And
Exactly.
secondly, sir, the scenario you gave last, that shares were issued to the management team, and when they will retire, the shares they have to buy it back. So I want to
Yeah.
ask, those shareholders, each year at the end, would dividend be paid to them?
Yes. If the management declare dividend, they will also get dividend. They'll get dividend since they are holding the company shares.
Okay, thank you, sir.
You're welcome. Have a wonderful night. See you next time. Bye. And endeavor to submit my assignment before the end of Tuesday. Thank you. Bye.